Insider buying is a very bullish signal because management buy, they believe the share price will go up, and today we're looking at 5 stocks that are trading towards their 52-week lows with a lot of buying. Now, as you can see, for our filter, we've gone for buys, at least 100 shares, at least $100,000, and within the last 14 days. Now, this is the list that you can see here. We're going to jump straight into the first one, which is the Dividend King, Johnson & Johnson, where the director on the 12th of December, so just a few days ago, bought around 150,000 worth of shares. Now, jumping into the company, for those that don't know, J&J is a multinational healthcare company. They develop and manufacture pharmaceuticals, medical devices, as well as consumer health products. And when we take a look at this Dividend King, they are trading right there towards their 52-week low. Their forward P sits at just below 15. The forward yield, very attractive at 3.5%. We'll show you that is well above the 5-year average. And we also notice a double buy from Seeking Alpha on Wall Street, with Quant currently giving this a hold. Now, over the last year, they are down around 6%. Over the last 10 years, we can see they're up around 37%. And if you did reinvest those quarterly dividends, you would be sitting at a marginally higher position. Now, in terms of their earnings expectations, always good to have a quick look. Over the next 4 quarters, only one of them is expected to be a growth, but we do like the fact that over the last 4, they have had beats, all of them 100% track record, great historical forecasting accuracy, which gives us faith over the next full year they will hit their EPS target, there in turn lowering the forward P to 13.78. Now, we can run through some of the metrics and then get to our valuation for each one of these. Dividend safety, 99, very safe, the highest score obtainable. A double severe undervaluation, which we will come to, and they have in this year increased the dividend at 4.2%, which is in line with the inflationary target. In terms of dividend safety, well, reaffirmed a few months ago, and what it ultimately means is that a dividend cut for J&J is highly unlikely. Now, key metrics, we'll go through each one, essentially how they performed in the 07-09 Great Recession. While J&J increased the dividend, they had above average growth, -6%, S&P was -12%, and they also massively outperformed in terms of recession return, -27%, the S&P itself, -55%, and we can see over the last 5 and the last 20 years, they have been increasing those dividends at a fairly attractive rate above the 4% minimum inflationary target. And as we said, Dividend King, 50 or more years of increasing those dividends, but they've also been paying a dividend without a reduction for the last 108. Now, in terms of looking at the first model, we do get an undervaluation signal here. The essential blue tunnel indicating the intrinsic value, the fair price, although you could say for the large part of 2024, it has sit well below that even bottom end, which does give us our first severe undervaluation. And then we take a look at dividend yield theory. Now, this tells us a company is undervalued with the current yield above the 5-year. That is very high, in fact, the highest they have offered over the last 5, and the forward P, again, giving us another undervaluation signal, 14.6, lower than the 5-year of 16.5. But on top of that, we can see very marginally it is trading at a discount to the healthcare sector of 15.2. Now, the first metric we're looking at here is the free cash flow payout. As always on this channel, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. We want to see below 60% as a blanket rule. Give us faith, by using this threshold, they will be able to increase the dividend at fairly attractive rates. Been around that year on year, 61% anticipated over the next 12, which gives us faith at a bare minimum they can increase it in line with inflation or ideally higher. Then we get to the free cash flow per share, where we want consistent increases over the longer term. Now, we do get that pretty much year on year, but do also understand a bit of inconsistency, and the growth won't be as much like we see for other companies in different sectors. Nice to report though, over the next 12 months, it is anticipated to increase to $8.19. And then we get to the sales growth top line. We want 3 to 7%. Really, we say 3 to 4 at the bare minimum, just to keep up in line with inflation. Now, year on year, you could say for the large part they hit there or thereabouts. 5% noted on a trailing 12 month. So we are expecting that pretty much for 2024. And you can see this in a numerical format. Now, the other thing we draw your attention to are shares outstandings. Are there companies that return excess cash through those share buybacks? Well, Johnson & Johnson is one of those. one thing we have noted actually is just over the last few quarters, they have been aggressively doing those share buybacks, indicating to us that management believe right now this company is trading at severe undervaluations. And as we've already said, and one of the reasons we are talking about this company today, there has been insider buying. Now, ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital. And we can see for the large part, it has been very consistent in the high teens, low 20s, which is a great sign. Consistency as well, incorporating that, investors will really find these numbers attractive. And then we get to the operating margin. For each company, we want to see two things. One, above the minimum threshold that we get with J&J. The second thing, we ideally want to see companies that increase their revenue like J&J have done, but also operating efficiencies increasing the margin, not something we can see. However, free cash flow, very consistent, free cash flow machine in the 20s year on year. We then move on to the final metric, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. And remember what these numbers reference. They are the number of years it would take the company to pay off all of their debt, net of cash on hand. And this correlates to balance sheet strength, dividend safety, 0.51 on a trailing 12 month, there or thereabouts over the next 12. Just reinforcing to us why we saw that 99 very safe dividend score, the balance sheet as well looking fairly healthy. Now we're going to jump into the valuation for each one of these, and our value is $175, the average of these three models that you see. And when we do our deeper dives on this channel, we run through each one of the models, the inputs, the outputs. Today we've got 5 to get through, and let's get straight to it, where we also like to apply a margin of safety for every single company. We use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode will buy at $158, then we keep going till it's near the current trading price. Now it doesn't hit the 20% level just yet, that would be $140, but at the 15% up to $149, this is giving you a fairly decent MOS. Wall Street themselves buy signal $178 over the next 12 months as anticipated, with upside of 22%. And don't forget, they are a dividend king. The yield is very attractive now. It does look very safe, and it could be one, if you are someone that does like dividends overall, to seriously consider in your portfolio. But as we go along, do give us your thoughts below about each one of these 5. Now we also want to let you know we have just released our latest free weekly article where we highlight 2 beaten down quality stocks that are a massive buy. Now we send one out every single Monday morning to your inbox, where we talk about severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, start reading straight away, where you'll also be able to gain access to 28 stocks for the month of December with lots of upside and severely undervalued. And you can see here the upside that Wall Street themselves believe for each one. And you can also grab another spreadsheet. Now these are 29 stocks that Wall Street themselves believe right now have the most upside in the S&P 500. So click below, you can sign up and start reading straight away. The next company we're looking at is Dow, where we actually get 3 buys, and that is from the director twice as well as the chair and CEO. And we can see these were on the 12th and 13th of December, and this totals just over $1.5 million. Now when we talk about the company, for those that don't know, Dow Inc. is a multinational material science company, and they specialize in the production of chemical, plastics, and advanced materials for various industries. Now in terms of the stock itself, well, it is down 25% over the last year. Over the last 5 years, we can also see down around 26%. Right now trading at its 52-week low with just a buy signal from Seeking Alpha. It does pay a very large yield at just under 7% with a forward P at 19.9. In terms of the earnings, well, 2 of the next 4, they are anticipating growth. And if we look back at the last 4, we see 3 of them at least being in line, 75% track record, although we do have to highlight massive growth is expected over the next full year, there in turn lowering the forward P to 13.6. Now we do have to bear in mind their dividend safety does sit at a 45 borderline safe score, but we get very similar to J&J, a double severe undervaluation signal, and we haven't got a dividend increase just yet over the last full year. Now it was reaffirmed just a few weeks ago. Now what this borderline safe score means is that there is a moderate risk of a dividend cut over a full economic cycle. In terms of the last full year, as we said, they have pretty much been keeping the dividend at a very flat rate, as we can see here over the last 4 years. And when we talk about the first valuation model, we can again see over the last 12 months, just in fact over the last 1 or 2, this company has been trading and moving more and more to a severe undervaluation, indicating a possible large market overreaction. In terms of dividend yield theory, well, as you can see, undervaluation quite severely, and on the forward P, actually a little bit of a different story, perhaps a reasonable valuation, given the current forward yield isn't far off the 5-year rolling, and in terms of the sector, it is marginally lower, the 18.6 from materials. When we take a look at the free cash flow payout, which is very important, we want 40% for those chemical producers. We actually notice over the next 12 months, it is anticipated to be triple digit 183%, which on reflection, what it tells us is that management are going to pay out more in dividends than they're going to generate in free cash flows. And that is why we do believe you do need to have a fairly large MOS with a company like this, just in case they don't increase the dividend or in fact do a small cut. In terms of the free cash flow, lots of volatility over the longer term, no real consistent growth, and we have to flag over the next 12 months, it is anticipated to drop by more than half. In terms of sales growth, now you could argue this company fairly cyclical. When we just look at the last few years, they have reported 4 of them essentially negative, and in fact 3 of those 4 at double-digit declines. And there again, when we do look at it on a numerical format, we can see the ups and downs on a year-on-year basis. What they have done, although a little bit inconsistently, because some years they've diluted your position, over the longer term, they have bought around 40 million shares, and that is a nice bonus when you are getting a very high yield, but also do factor in they haven't increased it over the last 4 years in which they did announce. In terms of ROIC, above 12% is what we want for the industry. A little bit inconsistent, 7% in 2023, something to bear in mind. And as we said, ultimately, this is why on this channel, we do use a margin of safety. The same to be said on both the operating as well as the free cash flow, lots of inconsistency. And if you are someone who likes to buy a company that you can have faith over the longer term will bring out those same numbers year and year again, maybe something like Johnson & Johnson, then perhaps this company isn't one for you. Net debt to EBITDA below 2.5, it is there or thereabouts over the last 12 months, anticipated to come down a little bit more, but when you factor this with the triple digit payout ratio, then you can see and understand why in fact we did get that borderline safe score. Now in terms of our valuation at $58, when we do run it through the MOS, you will find there is a fairly large 25% at the bare minimum. If you want 30%, you aren't too far off. So in reality, you could argue right now, Dow Inc. is trading at a 30% MOS. With Wall Street, a lot of upside, $55 price target, 34% over the next year. Now, in turn, you are getting a very high starting yield, but you do have to consider whether or not a dividend cut would put you off this company, and there is a real possibility that this is something we could see. Or alternatively, they will just keep the dividend at the same rate with no increases like we have seen over the last 4 years. We then move on to Centene Corp, where we actually get 2 buys, one on the 13th by the director of around $300,000, and then we get another buy on the 16th just a few days ago by a different director for around $600,000. So when we get more than one, it is a more bullish signal. We're seeing a lot of insiders perhaps fairly excited about this company. And again, for those that don't know, Centene Corporation, multinational healthcare company, they provide managed care services, health insurance programs that primarily focus on government-sponsored healthcare plans like Medicaid and Medicare. In terms of the company itself, like the majority that we have analyzed today, down 23% over the last year. Over the last 10 years, however, up 118%, trading right there towards its 52-week lows. We get a double buy signal from Seeking Alpha and Wall Street with a hold from Quant. Now, this is the first one and only one today that doesn't pay a dividend. In terms of forward P, sitting at 8.5. And if we take a look at the earnings, out of the next 4, only 2 of them to be growth. But one thing we love is a 100% historical accuracy over the last year, with EPS 7.16 at the end of next year, there in turn lowering the forward P to 8.07. In terms of looking at their metrics, well, it has been increasing over the longer term, nearly triple, but then again, you do have to bear in mind 2 things. One, inconsistency over the next 12 months as well, anticipated to come down quite sharply. And their sales growth, while overall looking very strong, we can see the slowdown in 2023 and on the trailing 12 month, we expect a fairly similar figure for 2024. From a numerical perspective though, their growth has been nothing short of impressive, and we do have to note they have diluted your position over the longer term. But bear in mind, for example, from 2021, they have been doing share buybacks, so it will depend at which point you did buy shares of the company. ROIC looking good. Yes, we acknowledge that it has been decreasing over the long term, but as we said earlier, a blanket rule around the 10%, which is what we have seen at the lowest point of this company over the last few years. Nice to report 10% on a trailing 12 month. And with the operating margin, whilst we would normally say this is pretty terrible, when we do compare it to others in the industry, this margin is pretty much in line, so no real complaints. Obviously, we would like to see this higher, and we would like to see some efficiencies. And the free cash flow, not really at the 5% level we want to see at minimum, other than the most recent year. Again, this is why we use the MOS. In terms of net debt to EBITDA though, we are very impressed in 2023 on a trailing 12 month and anticipated over the next 12, very low, indicating for this company it wouldn't take them more than 1 day to pay off all of their debt net of cash on hand. Now also bear in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for CNC or any others. But as you see, we get just under $90, a very nice MOS then, as you should be able to tell. At the 30%, a buy at $63. At 35, pretty much where we see this now, with Wall Street themselves very bullish over the longer term, 41% upside, $82 price target, and don't forget to give us your thoughts below. We then move on to the most recent one, that is Diamondback Energy, where we see the director just a few days ago buy around $1 million worth of shares. And for those that don't know much about this company, they are an independent oil and natural gas company. They're focused on the acquisition, development, exploration of onshore oil and gas reserves in Texas. In terms of their performance, well, actually up, but only marginally 3% over the last year. Over the last 10 years, up 165%. Actually not far off, if in fact in line with the S&P during the same time. They are pretty much trading towards their 52-week lows. We get our first strong buy from Seeking Alpha, a fairly decent buy from Wall Street at 4.28 out of 5, although we do note that typical hold from Quant. In terms of a yield, again, quite attractive yields in today's episode at 5.2. Forward P sitting at just above 10. And when we look at their earnings, only one of the next four anticipated to be growth. Bear in mind, cyclical industry. And the other thing we can see, only one of them they did miss, although that was the most recent quarter. And very important, we do need to let you know the earnings per share is anticipated to drop over the next full year. They're in turn marginally increasing the forward P to 10.6. Now we do get another borderline safe score at 50, although the previous one was 45. We'll cover these two models, but we can see a drop to the dividend over the last full year. And when we see the dividend safety score was reaffirmed just last month, as we mentioned, what this means, a moderate risk of a dividend cut over a full economic cycle. Now, over the last 5 years, on average, they have increased that dividend at a very rapid 75% rate, but we can see over the last full year, it is down negative 28. And then when we take a look at the first valuation model today, we can see based on this, over the last 12 months, for the vast majority, it has been trading overvalued, and that is the same conclusion today. But don't forget, we don't look at this model in isolation. In terms of dividend yield theory, we get the opposite conclusion with a nice undervaluation signal. In terms of the forward P, it does sit higher. So quite a lot of mixed signals in today's episode for this company. Although one thing is for certain, it does trade at a massive discount to the energy sector at 14.4. Then we look at the first and very important for a company that does pay a very nice yield. That is the free cash flow payout. Below 40%. Now we do anticipate that over the next 12 months. But bear in mind, cyclical company, we will expect that to show up in the numbers. And as we have just mentioned, the free cash flow looking very, very volatile. Although over the next 12 months, it is anticipated to jump up to $26. In terms of sales growth, again, volatility, cyclicality coming into play. Some years looking very, very strong, although we do have to point out, over the last full year, we did get a 12% drop. But on the positive side, on a trailing 12-month, 2024 anticipated to be positive growth to the top line. And you can see, no matter the fact that it has been fairly cyclical and up and down, over the longer term, their top line has been increasing. That is the same to be said for their shares outstanding, which actually for this metric isn't great, meaning that they have diluted your position over the longer term. Then we move on to the ROIC, where we want above 8% for oil producers, and we can see very cyclical, although the last 3 years are looking very strong in the double-digit region. In terms of the operating side, there isn't much consistency, but good to see above 12% every single year. Free cash flow, some years up, some years in fact negative. And then we finally get to the net debt to EBITDA, below 1.5 for this sector. 1.99 is what we get on a trailing 12 month, so we're not surprised why we did get that borderline safe score. The one positive, if they can execute that 1.21 expected, then that is a good sign. The very nice dividend does look to be safe, but again, that is why we do need to use a margin of safety. Now, our intrinsic value at $196, actually lower than Wall Street. Their price target, $215. They see 34% over the next year. Remember, we also got a strong buy rating from Seeking Alpha. At 10%, a buy at 177. At 20%, not there yet, but not far off. So around 158, we see 20% MOS. Wall Street, 34% upside. And this has been an episode for those that do like to look at very high dividend yielding companies and getting a fairly attractive MOS, as well as Wall Street giving some nice upside in their expectations. But as always, do take their forecasts with a pinch of salt. We then move on to LyondellBasell, with the director just a few days ago buying just under $400,000 worth of shares. And we can see, for those that don't know, a company that is a multinational chemical one that produces plastics, chemicals, refining products used in packaging, construction, automotive, as well as other industries. Now, in terms of the performance, they are down 21% over the last year. Over the last 10 years, a very rocky -7%, but as always, will depend at which point you did buy. They are trading at their 52-week low. We get a buy from Seeking Alpha. Now 3.5, so Wall Street not far off, although right now at a hold alongside Quant. And in terms of the yield, 7.1%. In terms of the forward PE, just above 11. And when we look at their earnings, very inconsistent over the next 4 quarters. 2 of them positive, 2 of them negative. The same to say for their previous 4, with only a 50% positive track record. Nonetheless, massive growth expected to the earnings per share. There in turn, over the next full year, lowering it to 9.15. We get our third borderline safe score at 51. We get a double severe undervaluation with a very attractive increase in May at 7.2% for a company, as we can see, yielding above 7%. In terms of the dividend safety, well, that was just reaffirmed last month. And then we get to essentially the dividend growth, 4%, so increasing it in line with inflation over the last 5 years. But over the last 10, very attractive high single digit at 9%, and they have been increasing those dividends consecutively for the last 11. In terms of the first valuation model, well, massive undervaluation. The first time we have seen this in 2024. And then we get to dividend yield theory, where the same is to be said, 7.1 above the 5-year 5.22, and the forward PE looking pretty much in line, so reasonable valuation, although we do notice it is trading at a massive discount to the overall sector for materials at 18.6. In terms of the free cash flow payout, well, no surprise then why we do get a borderline safe, 106% on a trailing 12 month. Nice to see, expected to come down to 66 over the next 12. And we do notice here a lot of inconsistency to the free cash flow. Sometimes that can put a lot of investors off. And we do also have to make you aware it is expected to come down over the next 12. In terms of sales growth, again, very similar to other companies we've looked at today, fairly cyclical, with 5 of the last 10 years being negative to their top line, and we can see that shown on a numerical basis. What they have done though, something we haven't noted from any of the companies today, a lot of aggressive share buybacks over the period, although we can see just over the last few years they have started to slow down that rate of buying. In terms of the ROIC, again, we get decreases over the long term. The only thing we can say is that it is near the minimum we want to see, perhaps something just to keep our eye on. In terms of both margins, not looking too great in terms of being at least at the minimum. So again, this all needs to factor in with our own margin of safety. In terms of the net debt to EBITDA, below 2.5 is what we want to see. We do get that. We have to point out it has been increasing over the last 3 years, although it is anticipated to marginally come down over the next 12. So definitely something to keep our eye on, pretty much for all the companies today that did have that borderline safe score. Now, intrinsically, $100 is where we get to. Wall Street themselves, 95. They see upside of 27%. And when we do go through the MOS today, at 20%, a buy at $80. at 25, pretty much where we see it now. So again, whether or not it is justified based on all of the issues that we have flagged, or maybe you're someone who does need a little bit more. Our conclusion for LYB, 25% MOS, 27% upside. Do give us your thoughts below whether or not any of these are interesting. Maybe some of these you have been buying or in fact recently sold. Don't forget to sign up to the free weekly newsletter below, grab those 2 spreadsheets, and come and join us in the Patreon where we do cover our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.